What's going on, traders? It's Chris at Verillo Trading. Welcome to this video. Welcome to my apartment. As you can see, there's the flamingos. They've been there since the start of this YouTube channel. So thank you for watching. In today's video, we are going to talk about four things or four trading skills that you only learn by actually trading. You can also use these four things that I'm about to talk about to you guys to screen potential trading mentors and basically tell if someone's bullshitting you straight to your face about trading. If you have a course, if you have a very good mentor, even that will not allow you to become high level and experienced in these things I'm about to talk about, because these things need to be learned and practiced and developed. You need to take the time, the screen time, to work it out every single day. You will not become a better trader by watching a YouTube video, but I can point you guys in the right direction and share with you guys a few things that have helped me over time to become more consistent and more confident in my trading methods, and overall just a better trader. So thank you for watching. Let's get to it right now. And remember, if you enjoyed this video, if you relate to this, you can press the like button to help the channel out. The first thing we're going to talk about here is learning about your own risk tolerance and how your risk tolerance fits in with your trade setups. You need to stop getting fixated on what other traders are doing, how much size they're trading, and what products they're trading and how they're trading. Unless that trader is your mentor and you are able to watch them trade every single day, many days in a row for a long period of time because you're learning from them, then there is no reason for you to waste your energy watching any other traders or getting fixated on how much money other traders are making or losing, unless you can make a logical argument as to how that's helping you make money in the markets and develop your edge. So let's talk about risk tolerance. This is very important. Everybody who interacts with the markets has their own unique risk tolerance, which means how much are you comfortable losing, meaning that you can lose that amount and just go on with your day, go on with your merry way, and not be so emotionally distraught from your experience, from the trades that you took where you potentially experienced a financial loss. And the same goes for a financial gain, because if you're having P&L swings and your emotions are swinging along with those swings, trust me, you're not going to last very long in this game. You need to be able to accept the risk, fully accept the risk of each and every one of your trades. And what I'm talking about here is also going to tie into what I'm sharing with you guys later in the video, because we're going to talk about position sizing and trade management with scaling out of trades and how that's going to impact your expectancy as a trader. Look, if you're taking trades that are exceeding your risk tolerance, you are going to impact your decision making in a very negative way. You can feel this, and the only way to learn your risk tolerance is by actually trading. And you need to start trading small and gradually increase the size of your trades until that dollar amount associated with your trades is starting to impact your emotions, where you can actually feel that your decision making is getting slightly impaired by the amount of trading size that you are using. You can have a trading plan. You can construct a plan that has a certain outlook on the market. Whatever the plan is, you have a certain amount that you are willing to risk in this trade, or for each trade that you take. You might not even know what your actual true risk tolerance is, because in your mind, you might saying, well, I don't mind if I lose $200 today. You have to actually experience that being down $200 to actually know what it truly feels like, because your perception of risk and the way your body actually responds to the risk you're taking is two different things. In your head, you're saying, I don't care if I lose 500, but trust me, when you're down 500, you're starting to think what else you could be doing with that money instead of losing it in the market on a stupid trade. So if you think that your risk tolerance is $100 per trade, risk less than that to start. If you're trading futures, trade micros, micro S&P 500, micro crude oil, micro NASDAQ, micro gold, whatever it is that you're trading. If you're trading shares, trade small amount of shares. That way you're going to be able to ease your way in. And say you're trading and you're on a bit of a hot streak, you feel that you're reading the market well, or you know very well what your A+ setups are, you can increase your risk a little bit on those setups. So you sit there, and we're going to talk about this as the video goes on here. You have your setups, you know your setups, you wait for your setups. On the setups that you know that you have probability in your favor, you have edge in your favor on those setups, you increase your size a little bit, see how that impacts you. If you're feeling that the increasing of the size is impacting you too much, you're gonna have to lower that size. You have to gradually ease into this, guys. Risk tolerance, learning your own risk tolerance is something that is so important in trading, because if you are trading outside of your risk tolerance, you are going to be very much negatively impacting your decision making abilities. All right, here's the next point, guys. I'm gonna use my awesome text tool here. I'm gonna type it for you guys. Second point, learn trade setups, stat track them, back test them, whatever you can do to get trade statistics. Next thing is learn how to wait for your setups. Next thing is learn how to fight for setups when they're there. All right, let's talk about these few things here. Put it on the screen. There we go. So now trade setups is an interesting topic. People have different, views on trade setups. A trade setup, guys, is any collection of variables that come together to give you some sort of an edge or some sort of scenario where you can see that the probabilities are skewed in one way or another. You can say X, Y, and Z variables is equivalent to this trade setup that is a high probability long right now. You need to learn setups, you need to develop setups, and you need to test setups ruthlessly. Once you have the setups, you have to learn these next 2 points over here. Some people will argue that a moving average crossover or a moving average test is a setup. Maybe it's a setup. I think it's pretty low probability, but in my opinion, you want to have confirming factors that make a trading setup. One trading setup I could describe to you guys is a mean reversion play or some sort of a trading range play. But the idea of a trading range play is something that is so vague that if I don't go more in detail and explain to you, under what circumstances will I be looking for a trading range play, and how exactly will I perform the execution of this trading range play, all of that are little fine nuances that go into the trading setup. So the trading setup is like the shell that encompasses all of the nuances and execution techniques that go into, your trade from start to finish. As traders that prioritize trading the highest quality setups, we have to know how to wait for setups. Trading is a lot about waiting, guys. There's a big waiting aspect involved with trading. You can sit there sometimes for an hour, you look at the market and you say, there's nothing here for me. Having the maturity to look at the market and say, there's nothing here for me, or the volatility is not right, or whatever it's doing is just not right for what I'm looking for, that comes with experience. You cannot learn this other than by actually trading day after day after day and trading setups and getting chopped up on bad days, learning how to wait for setups and maintain that composure, and learning how to sit through, some back and forth in your P&L for a while. This is why it's very important that when you're trading, you have to be looking at it from the bigger picture, not just today's P&L, not just this week's P&L. You really want to be prioritizing your process of having your setups, waiting for your setups, tracking your setups. And when your setups are there, don't just give up on them after one attempt. That brings us to the next point here, fighting for setups. Basically, it means when your setup is there, it doesn't necessarily mean you're gonna have a 100% easy time getting into the trade. In fact, most of the times, the best trades, sometimes the execution can be a little bit tricky and hard to get into, because you can guarantee that there's probably other traders that see the same exact thing and they're also fighting for it. And especially if it's a setup that lines up on multiple time frames where you're gonna have multiple players all looking in the same direction at the same time, there's a good chance you're gonna have to fight for that. You're probably not gonna get the best price, and you might even have to try 2 or 3 times to get into the trade. Fighting for a setup, simply referring to the idea that you need to be a little bit flexible in your execution. You may need to exit and re-enter at a worse price or at a better price. You have to have some techniques in your execution that allow you to be a little bit flexible upon your entries and your exits of your trades. You can't just expect to get into the trade, it's either going to work or it doesn't, and that's it. A trader who knows their setups very well and who knows the dynamics of a market and how it trades, you know very well that sometimes you just can't nail trades based on whatever the market's doing, the condition of the market. You can't nail those perfect entries all the time. And sometimes you're going to have to exit, re-enter, or you're going to have to leave more breathing room for your trade upon the first entry, or you might even give yourself multiple entry points. Whatever it is that you do, to manage your entry points for your setups, you're going to have to do that. You can call that fighting for a setup or whatever the fine nuances that go into the execution of your setup. You know, if you guys are enjoying this, let me know down below. Write a comment. I'd love to hear your thoughts on trading setups. All right, guys, here's number 3 for you. Control T. I'm going to show you guys how to type like an absolute beast because I've been playing keyboard for a very long time. Number 3, here we go. Learn how to manage trades and study the implications that scaling out may have on your longer term expectancy. Let's talk about managing trades and scaling out. Okay, so this is relating to trading multiple contracts if you're a futures trader, and it's relating to the topic of scaling out. Scaling out means you have multiple exit points, and every time you exit, you're not exiting the entire trade in one shot. Okay, let's say you bought it over here at this price, 69 and a quarter, whatever that price is. A scale out trader, what they do is they have their initial profit target. They're gonna get filled on their first target over here. They might have sold, let's say, 20% of their trade, and then as the market moves in their favor, they sold another 20% right there. And now they have a remaining 60% of their trade, and then the market moves again and they sell another 20%. Now they have 40% of their trade left. That's scaling out. In trading, you need to understand how scaling out is impacting your longer term expectancy. I will give you a few examples of things that I've discovered with scaling out. Let's say you're futures trading. You trade one contract. The first thing is I want to address a common myth. There's some people out there that say if you can't trade one contract profitably, then you should not be trading more than that. That is a false statement, I believe, because the longer term expectancy that is associated with trading a one lot is very much different than the longer term expectancy of how you would manage a trade trading a 3 lot or more. Because when you're trading a 3 lot, what you can do is called scaling out, and you can leave a runner, and that little small percentage, the remaining position of your trade, has the potential to go to infinity if you let it, and you're going to have a small percentage of trades that are going to make up for a large amount of losing trades or break-even trades, because what you're doing with that small percentage of trade that you're letting ride is you are skewing the risk to reward in your favor. Now, it's very important to understand how scaling out different position sizes is going to be impacting your expectancy. So let's say you get into a trade with one contract or one share. There's really 2 things that you can do if the market moves in your favor. It's either you are going to take a profit when the market moves in your favor for a measured move at your profit target, or number 2, you're going to let it ride discretionary and try to squeeze the most you can out of it. And this is a tricky one, isn't it? Because there's some trading setups, you guys know this. No trading setup is exactly the same. There's some scenarios where the target can be a little bit ambiguous. You do not know what is going to happen when the market achieves a certain area. You could make an assumption. You could say, well, look, I think if this area breaks, something's going to happen. I don't know what, but it's either going to be a flush through the price by 6-7 ticks, or it's going to just get absorbed and then chop and then nothing's going to happen. What I'm trying to argue to you guys is that there's scenarios where you just do not know what is going to happen. And if you are always running with fixed targets, you're missing out on that discretionary aspect that you can use to your advantage to say, well, I'm just going to let this ride and I'm going to see what happens, because this trade has the potential to be that 5-to-1 or that 3-to-1, whatever it is you're looking for on the trade. And the thing is, you can't really do that with a one lot, because with a one lot, if you're letting trades go to break even all the time, you're going to look at your trade stats and you're going to say, wow, this is really hard. Either I am getting paid or I am totally getting a break even, and I'm never ending up with these trades that end up running in my favor. And the reason for that is because generally it's a small percentage of trades that are going to become those big 3-to-1s, 5-to-1s, etc. If you trade 2 contracts, now you're changing the expectancy of that. So let's say you trade 2 contracts, you buy one over here at 69 and a quarter, and now at your first target, you scale one out over here at 72. And now you're left with 50% of your trade. Now, I'll be honest with you guys, this is only a little bit better than trading one lot, because what you did is you removed half your position size. Now you're left with the other half. Well, what's going to happen is if it comes back to break even, you let half of your entire risk come back to break even. in the long run, you're gonna see that hurts you. Now, let's change it a little bit. I'll explain to you how you can improve this even more. Let's say you now trade 4 or 5 contracts. So let's say again, you enter over here at 69 and a quarter, you buy 5 contracts at S&P 500 micros, because I'm not a risky motherfucker to trade the minis yet, because I know my own risk tolerance, right? So you buy 5 of them, 69 and a quarter, you scale your first 2 or 3 up here at 72s. Now you're left with either 1 or 2 contracts left. Probably that makes up around 20 to 30% of your risk on the initial entry. Now, from a longer term standpoint, letting 20% ride, even if it goes back to break even, that should be a lot more acceptable than if you're letting 50% of your trade come back to break even. So do you guys see what I mean? When you're trading more contracts, like 3 and above, you can skew your longer term expectancy in your favor by letting around 10 to 30% of your trade go as a runner, and it's up to you how you want to manage it. You could be a little bit discretionary if you want. You could say, you know what, I'll let it ride until I see something, or you could say, I'll let it ride no matter what with a volatility based stop loss, and when it stops me out, it stops me out, or if it goes to infinity, it goes to infinity. You can be mechanical or you can be discretionary, but the point is, small percentage of your trade is left to go to infinity. Leave the possibility for that to happen, and it will skew the risk to reward in your favor in the long run. The last point of the video, guys, if you're enjoying this, press the like button. Let's go on to point number 4. This one's a little bit unorthodox, but I think you experienced guys out there might relate to this. This one will not really work for beginners. Let's type it out. Listen to YouTube traders and find patterns. This mostly applies to experienced traders that have an established system that they follow ruthlessly. This is an interesting little point that I wanted to share with you guys in this video. It's sort of a bonus point. So as you guys know very well, if you don't know this, YouTube traders are not traders. Actually, that doesn't make any sense. What I mean is, when people are uploading videos to YouTube, YouTubers with a lot of subscribers, with clickbait thumbnails and good titles, compelling titles like me, the YouTube game is not the same as the trading game. It's 2 different games. So when you're watching a YouTube video, you have to understand, especially if it's a video that's receiving a lot of engagement, activity, what it means that the person who made that video is good at YouTube. It doesn't mean that they're good at trading. Okay? That's something that you guys have to learn and understand. Just because a video has a lot of views and a lot of likes and a lot of engagement doesn't mean the person knows how to trade. Some people will even argue the opposite, and they say the more famous a YouTuber is, the less the probability is that they're actually a good trader. I don't know if that's totally true, okay? Because look, I enjoy making videos, and I also enjoy trading quite a lot, and I enjoy making content that is helpful, that people can reference in years to come from now. So for me, whatever you guys, I'll let you guys label me. If you guys think I'm full of shit, let me know down below. It doesn't really matter to me. So what I want you guys to take away from this is that this is a skill that I learned from another trader. And what he does, this trader, is he goes and watches pretty much every single YouTube trader he could find over there on the internet, on YouTube. And he watches them. He watches the live streamers. He watches the technical analysis guys, where they're making mistakes, where they're messing up, where are they doing well, and where are they totally messing up. And basically, you know, you can do this in anything, guys. As a musician, look at the musicians playing on the stage. If you're a guitar player, you're looking at the guitar player. What would I be playing in his position right now? What would I do as a trader in the position of that trader to be doing something better than what they are doing? How can I learn from their mistakes? How can I profit from their mistakes or from their absolute lack of trading ability? So I've definitely found scenarios is that where you're tracking the sentiment of a certain marketplace, you can find patterns in the content that is being uploaded on the net regarding those particular markets, the sentiment, you know, the crowd sentiment and all that, right? So guys, I hope this video helped you. Let me know down below. Thank you for watching. I hope to hear your awesome comments down below. I'm gonna go shred some guitar now while I edit this video. Just kidding, I'm gonna edit this video for like 3 hours. Take care, bye.